Well, hi and welcome to another video in this training series. Now, the first video that we went over, we talked about the three essentials, or the underlying core principles, if you like, of the market based on my methodology of trading, which is that of accumulation, manipulation, and then the profit release cycle. Now, during that video, I mentioned briefly or touched briefly on the market makers, and what I want to do today is to really break that down for you so you understand when I mention the market makers in the future, you have a real understanding of what I'm actually referring to, because although we use the term market maker and we just name them as something, what I want to do for you is to explain to you the business that they are running, the business that they are in. So I've set up these slides behind which we're going to work through now, and we're going to be looking at the market makers, we're going to be looking at the quoting prices, we're going to be looking at the bid and the ask, and we're going to look at the market makers are in business. So they're in business actually to produce profits. Now, a lot of people don't realise that when they actually set up the trading, they see the dealing platform there in front of them, and they just think it's there, that's it. They click on buy and sell, whatever. They don't realise there's a whole industry that's actually behind that facade that we see. The whole thing's going on behind there. And the market makers are there, and they have to maintain the bid and the ask, so that obviously you can then, those bid and ask prices are always there for us then to go in and deal at, whether we want to buy, in the case obviously of buying or selling. So what I would go to first is I want to look at how the market makers actually make money. Now there's three things. They have the bid and the ask spread, they have the trading of their own accounts, and they have commissions and fees. Okay, so what I want to talk about now is the bid and the ask spread. Now this is the piece in between the middle, so we've got the bid and the ask price and the piece in the middle, and that is a market maker's profit zone. So for example, if I want to buy and then I want to sell, I will have the difference between the two, which will be the spread, and that will be takeout. So win or lose, whether you win or lose as a trader, when you buy and sell, there's always that spread, and they take that, that's their spread, that's their profit margin that they just extract. So from a market maker's perspective, broker perspective, it doesn't really matter whether you make any money or not. They always make money on that transaction as that comes out. And often we hear about, you'll see that companies will advertise a tighter spread or very small 1 pip spreads and things like that. But there's lots of different things that they're doing to actually juggle the figures around. So at the end of the day, they all take that slice out the middle there, that piece out the middle, which is their profit margin. And that's one way onto there. Now the second way, trading their own accounts. Now if we have market maker companies, we've got two companies, let us say, they're trading their own accounts, and they can obviously go into the marketplace. Now we're going to talk about later about why and how they do that, but basically as long as you understand that the market maker is not somebody that's sitting behind there doing nothing, just sort of presenting prices to you, they are actually actively trading their own accounts as well, and that has some quite severe implications for you. And commissions and fees, that's fairly explanatory. Commissions and fees they get for bundling lots of shares or whatever together, and then they push those out to institutions, pension funds and things like that, so they take a commission on that as well. Okay, now what I want to talk about now is the actual accumulation process. Okay, now this is the market maker's accumulation process. You remember we talked about accumulation, we talked about manipulation, and we talked about the profit release cycle, and they're the three things that we're going to cover now, but we're going to look at them now as an actual process. Now the first off we get to is assessing supply and demand. Now I want you to place yourself in a position where if you could assess the supply and demand of any given market that you wanted to trade in, that would be tremendous information for you. So in other words, if you knew that there was demand, let us say for $1, you could start now buying up the dollar, ready to sell it on later at higher prices, and thus releasing a profit. This is no different, and this is exactly what the market makers are doing when they're trading their own accounts. Now, how would they do that? How would they go about doing that, or how would they go about manipulating the market if to achieve that aim? Now, what they can do is releasing news and forecasts to the media. Now, again, a lot of people think that the news is there as a separate entity, and that sort of comes out, and away that goes and moves the market. Now, I ask you to consider something here. If I set you off on a journey today, you're going to be a reporter, and I want you to go and report on the state of the sheet metal industry, we'll say, just choose that as an example. Where would you go? Well, it makes sense for you to go to the sheet metal manufacturers and go and start asking questions of the state of the industry, etc., and you could then do your news report on that. You wouldn't go to a baker. Okay, so where do the financial journalists go, and where does everybody get the news from? They get it from the city, they get it from the market makers. And that gives them tremendous power when it comes to accumulating the accumulation process. And Thirdly here, accumulate without moving the prices very much. It's very important that also you understand that the way in which accumulation is done, you don't want to be seeing markets that are trending up or trending down, although sometimes that happens. I'll explain that to you in later lessons in charts. But generally, accumulation will occur through a sideways period of the market. The market makers do not want the prices to break out of this level, this band, if you like, that's going on, because once that breaks out, they can't accumulate what they want to accumulate, and so their profit potential drops away quite dramatically. Okay, the manipulation process. Now, how is the manipulation process done? This involves misleading information. We can have rapid false moves, manipulating chart indicators, and hiding any accumulation signs. Okay, misleading information. Now this comes back to our news situation, or just general alerts, as it were. Now a lot of dealing platforms today are wired directly in to the markets, to the market makers, to the news media, so that as you're trading along, the news stories are popping up all the time. And if you've looked at this for any period of time, you'll just see the enormous amount of information that is coming out, that's dripped out in the terms of news, which all has little effects on the market, as it were. And if you can keep dripping that out, of course, now you can control how the market actually moves before the masses start jumping into the market, because they will do that, but you don't want that to happen just yet, because you need to go through that accumulating process. So misleading the market by dripping out that information, and also creating quite erratic, sudden, quick movements. If you've been trading again for any period of time, you'll recognise sometimes you have these quick, rapid movements, and that can manipulate traders' beliefs as well. Manipulating chart indicators. Very briefly on this, I will get a complete section, a video on this, but very briefly, if you are trading sort of standardized indicators, moving averages, MACDs, overbought, oversold, all those hundreds of different indicators that you can actually put on, these are standardized indicators. Market makers know how these work. They know which are the standard settings for these things. And of course, by manipulating prices and beliefs around that, you can actually get the indicators that the general masses use to indicate buying indications, to indicate selling indications. So by controlling how the price moves, the beliefs and what makes the prices move, you can manipulate ultimately charting indicators. Hiding any accumulation signs. Well, again, we've just sort of touched on that, but I'll just briefly again, by keeping a market contained within a band, narrow band, as long as the price is moving up in a fairly tight range, then everything will be hidden what is going on. Now when I say hidden, if I as a market maker want to accumulate buys or accumulate the dollar ready to sell to rise, I want to accumulate it now without putting the price up. And the way in which I can do that is to keep the market subdued, but while the market is going sideways, every time people are buying and selling and buying and selling, I will be buying and accumulating those buy orders ready for release later on. This brings us now to the profit release process. And what we're looking at is exposing signs of strength or weakness, encouraging the trading masses to participate, providing news and forecast to the media instantly on dealing platforms. Okay, exposing signs of weakness or strength. When the market makers have accumulated the amount of stock that they require, in this case we're using dollars as an example, they've accumulated the amount of buy dollar orders that they want, they're ready then to release that. By exposing their hand, as it were, by exposing and showing strength in the market, the masses will now rush in, and the market will start to move off as the masses also start to buy and accumulate those buy orders. Now, encouraging the market makers to participate, again, that's just really moving the price away. News stories are coming out, and then encourage the masses in. Now, very, very important you understand that how a market maker actually makes money, or how you make money, because they're no different except that they're sort of they're sitting behind. We're at the front edge, they're sort of sitting behind there. If you've gone through the accumulating the dollar, the only way that you can actually profit from that is when you sell that. Okay, so you've accumulated, you must sell it. Now, who is going to buy? Who is going to sell it? Well, you are selling what you've bought into a rise. So in other words, once you can convince the outside market to come in and the market's going up, suddenly they want to buy. Where do they buy from? They buy from me, the market maker, or the market makers. I shouldn't say me, but they buy from the market makers, and thus the market makers sell into the rise. We'll come to that on the last slide. They sell into the rise, and thus they release their profits. Okay, so the profit release phase. Let's bring this right to this end now. Now what we end up is we've got the accumulation area, in this case at the bottom, obviously that could be at the top if we were looking at a downward moving market. We then have a selling into the rise to release profits and the dropbacks, which we'll talk about in a second, and then eventually we have a return to the accumulation phase. So just finally here, because we're running out of time here, what's going on? Once that accumulation is complete, once the manipulation process is over, the hands are shown and the market then breaks off. The market makers are now into a profit release cycle. They now profit from the rising market as they sell out what they bought at a lower price to you, the trader, entering in. We are allowed to make profit at this point, as the market makers are making much more profit than ever we will. And there's other things I want to talk to you about, that how we make money as opposed to they make money later on, but that'll have to come on later slides. Okay, now very important you understand on the selling into a rise concept, that as the market starts to break out, you will often see a market, if you've been looking at markets for any period of time, the market will start to go up, the market will then drop down, the market will then go up, and then the market will go down. What's going on? What is causing this? Now there's whole sorts of technical theory as to why this goes on, but actually happens, what's happened is, as the market starts to break away, and the outside masses come in ready to buy, the market makers are then pushing out the sell, so they're pushing out the sells, pushing out the sells, pushing out the sells, releasing more and more profit as they go, until the end they get to the point where there's so much going out, it catches up, and then the market drops back down again as the selling swamps out and overtakes the buying. But of course this is going to continue. The market makers know there's underlying strength. The market drops back a little bit. Market makers start to buy again at that point, because some traders will start to sell at that point, accumulate again, ready for the next rise, and then the next rise goes up, and as it goes through the little left, the little high, the little hump that is made to the left there, that will trigger. Other traders will come in. Now there's more buying. As it goes off, it tears off very quickly, and again, once again, the market makers push that out and sell, and that carries on repeating up and up and up and up in the case of an upward moving market, until everything that the market maker has accumulated has been distributed out, been sold out, and all the profits have been made all the way up. Now we have the outside masses, being the outside traders, are now long in the market, waiting for it to continue to rise, but the game's over. It's finished. And now, as that cycle is finished, the only way the market's going to continue either up or down is if it goes back into another accumulation cycle. Okay, now I know this has been a lot to cram in on this. It's been very tight, but I've done as best I could to cram the information in given the time we've got. But we'll be going over more on this, but basically, as long as you're understanding about this process, what the market makers are a business, it's what they do. And just finally, before I go, I explain something to you. If you consider most people actually look at the facade, they're looking at the form of the market, and the form is like the charts that we look at. The content sits behind, and the content never ever changes. Never changes. And that content is one of accumulation, manipulation, and profit release cycle. That cycle never changes, and that is exactly what I teach. That is what I do and have done for many years. But that's what you learn, and that's what we're trying to learn going through this. So when you're looking at charts, keep this in mind. That's the facade you're seeing. That's the thing like shifting sands, the different indicators, the different chart patterns, all the things that traders look at and all the different indicators. That's forever shifting sands. That's why so many traders have so many problems trading. The bit behind, which is what I teach and teach you how to trade, is the content of the actual market. There's three things: the accumulation, manipulation, and the profit release cycle never ever change. And once you learn how to trade the content of the market, your technical analysis days are finished with, and you are going to have something that will consistently work until the end of time, until that, or until, as the case may be, the market makers decide they don't want to make any more profit. Well, we'll assume that that's never going to be the case, and we'll always have something to trade based on a solid, firm foundation, like I say, that will never change. Anyway, have a great day. Catch up with you very soon.